Good morning. It's really afternoon, but I thought I'd say it anyway because I said it in class normally. But anyway, let's take a look at the chapter 7 information. This chapter covers fraud, internal controls, and cash. You ready? Let's go. Perhaps you're saying, what is fraud? That's a good question. Fraud refers to any dishonest act by an employee that results in personal benefit to the employee at a cost to the employer. You want examples? Okay. Remember that one time you ran late for work and you called your coworker? Say, hey, can you clock me in? They said, sure, I can do that. You know what? That's fraud. Okay? Or that time that you needed supply, whether it was paper, pencils, a calculator, staples, etc., and you decide to help yourself in the job or the employer supply room, that's fraud too. So fraud refers to any dishonest act by an employee at a cost to the employer. Regardless of the amount, it contributes to what's known as fraud. Now, there are certain factors that lead to fraud. Those three factors are opportunity, financial pressure, and rationalization. Sometimes when fraud is committed, people say, wow, I never thought that he or she would do something like that. Often people commit fraud because of financial pressure. Perhaps they're having a problem paying their bills. And they see fraud as an opportunity to get the financing needed to take care of their personal obligation. Often fraud is committed when there's also an opportunity, meaning that a company may not have the appropriate controls and procedures in place in order to prevent fraud from taking place or to catch the fraud once it has been perpetrated. And then we have this third factor known as rationalization, meaning that people try to rationalize why they are committing fraud. They'll say things like, I deserve this money. They're not paying me enough for what I do. So if I decide to embezzle some funds from the company, hey, I deserve it because I work hard for this company. So normally when fraud is committed, these three factors are in place. The person has opportunity, they could be under some type of financial pressure, and they will try to rationalize, can't speak right now, why they're committing the actual fraud to begin with. So, back in 2002, too fast, the Sarbanes-Oxley Act, which was passed, it changed the way that public traded corporations have to address what's known as an internal control system. Now, every public corporation must have in place some type of internal control system, policy procedures that we'll talk about. This is an order by the PCABO, the Public Company Accounting Oversight Board. So because of the Sarbanes-Oxley Act, when a company has an audit done by an outside independent auditor, they're going to audit your financial statements, but also audit your internal control system. The internal control system must be put in place. It needs to be both reliable and effective. So first I want to know, do you have an internal control system put in place? If so, is it working? So we're going to talk more about what an internal control system looks like and how do you put policy procedures in place and how do you implement those to make sure that they're being adhered to. So internal controls, these are methods and measures adopted to, so we're really talking about policies and procedures put in place to safeguard the company's assets, to ensure that we have accurate and reliable accounting records, to increase the efficiency of operations, and to ensure compliance with laws and regulations. So when companies put these procedures and policies in place, again, they're put in place in order to safeguard the company's assets, make sure we have accurate, reliable accounting records, to make sure we're operating efficiency and that we're in compliance with laws and regulations. Remember that every public corporation must have in place an internal control system. Okay? So first think about your place of employment. Okay? Whether it is a current employee or a past employee. I want you to think about what type of policies and procedure has your company put in place in order to safeguard the company's assets, to make sure you have accurate accounting information, to make sure that the company is operating in an efficient manner. It could be something as simple as your computer is password protected, or you may need a certain ID to get into the building, and they may check that, okay? Or we'll look at some of the policy procedures the company put in place in order to safeguard their assets. First up, establishment of responsibility. This is a control put in place where only one person is responsible for is given a certain task. For example, I know that some of you may have worked at a place where you're overseeing cash. You may have your own cash register. A simple procedure we can put in place is at the end of your shift that you're going to count down your cash drawer to make sure that your drawer has the adequate amount of cash in it before the next person takes on that shift. So establishing responsibility is just one procedure we can put in place as an internal control activity. Segregation of duties. This is saying that you want to make sure that there's proper separation when it comes to handle a certain type of function. For example, we're dealing with accounting, we're dealing with assets. So perhaps you deal with a company where money comes into your organization, whether in the form of cash or a form of check. You want to make sure that you have different employees overseeing different responsibilities. For example, employee A may maintain the cash balance per books. So employee A is the person that's actually recording the information to the accounting system, go to journal entries, post a ledger account, etc. But employee B maintains control or custody of the actual cash on hand. So their job is maybe when the cash comes in to actually count the cash money, do maybe a deposit slip, deposit the information, and then they're going to send the actual information to employee A. You don't want to have the same employee count the money and record it. Why not? Because now that person has too much control. They're going to have the opportunity to commit fraud because they're the person receiving the actual cash that comes in and recording to the accounting record. So making sure that certain duties are separated is an important process when it comes to internal control procedures. Next, we have documentation of procedures. Let me ask you a question. For your job, do you have a job description, a written job description? You say yes? Well, good. It is important that we have things documented in our place of employment. Even things such as invoices, sales receipt, checks, etc. Those items need to be documented. and they need to be pre-numbered documents. So when we're doing invoices, we should go in order, invoice 1, 2, 3, 4, etc. The reason why you have pre-numbered documents, it allows you to keep track of things. So think about if I have a checkbook and the checks are from check number 100 to check number 150. If a check is cash and that check number is 210, that's a red flag, right? Because we're not even using those checks just yet. So by having pre-numbered documentation, it allows us to account for our different type of documents. There are also controls that we call physical controls. Simple things such as a time clock for people clocking in and clocking out. Having a safe in order to put valuable assets away for a company. Even having a television monitor as a security system. Okay? Your computer typically has some type of username and password that will allow you access to certain type of information. So these are examples of different type of internal control from a physical standpoint that we can put in place in order to try to safeguard our different assets. Okay? Independent internal verification. Yes. What we're saying now is that remember that we have the one employee who actually recorded the cash transaction to the accounting records. We have the other employee who controls the physical cash that's coming in. Then you have the assistant treasurer who's going to verify the information that was reported by the assistant cashier and by the accountant employee. Now, the records of these two should match the information given to the assistant treasurer. If that information does not match, we got problems, people. So independent internal verification means that there's going to be another party to verify the information provided by these two employees, and their job is to look at the discrepancies reported by these different employees. So you want to make sure that, again, we're talking about duties being separated properly so that we have an effective internal control policy put in place. Human resource controls. What are those? Things such as having employees bonded. What does that mean? It means that we have an insurance policy of those employees who actually handle cash. So just in case they get a little sticky fingers with the actual cash, we have a policy put in place so that if money is stolen, then the actual insurance company will replace those funds and they would go after the person that actually stole the money from us. Rotate employees' duties is an example of human resource control where you have different people doing different duties to see if employee A is out, do I get the same result when employee B is doing their work? Require vacation. You want to make employees take vacation. Why? So once again, when they're not there and somebody else is doing their job, are we getting the same amount of revenue as before? If not, that could be a red flag. Conducting background checks, criminal background check, credit background check is an example of control put in place from a human resource standpoint. I'm going to end this video presentation now and come back with a second video, more information about internal control policies and procedures.